Today, I want to talk about how Congress is finally investigating illegal shorting. I also want to talk about how Robinhood is being punished for their market manipulation. And finally, I want to give some of the latest updates on the AMC lawsuit. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Congress is finally investigating FINRA's U3 halt and the synthetic shorting of MMTLP. The article says that FINRA is under pressure as new email transcripts emerge, exposing the corruption in the stock market. FINRA currently has multiple lawsuits filed against them for securities fraud in the state of Florida and California. And now an actual member of Congress has made an official request to FINRA for the MMTLP blue sheets, and investors are getting the FBI involved as well. This member of Congress has also asked for more information and for help in investigating FINRA. It says the new email transcripts prove that FINRA was aware of the fraud and they still allowed it to trade for over a year. So this Congress member is requesting the blue sheet data from FINRA for MMTLP, and a congressional investigation letter was recently sent out to the CEO of MMTLP. So this member of Congress isn't just asking anyone for help, he's actually gone directly to the CEO of MMTLP. Mr. Sessions states the US House Financial Services Committee and the US House Oversight and Accountability Committee and his office is all gathering data that will be helpful in oversight analysis, protecting investors, and potential legislative efforts to reform Regulation SHO. And that member of Congress also stated that he's encountered numerous issues with FINRA as well. He said that several issues have been brought to my attention surrounding the trading and ultimately the U3 halt issued by FINRA on ticker symbol MMTLP. He said it's my understanding in talking with FINRA personally that there's been a hiccup in the matter and there may be short positions that have not been settled in the trades of MMTLP. And actually the CEO of OTC Markets has also publicly stated that there are indeed short sellers that are trapped because of the FINRA halt. Obviously these short sellers have been trapped on purpose, effectively because they requested to be trapped so they didn't have to close out of their short positions. So Pete Sessions, the member of US Congress, has written this letter directly to George, the CEO of MMTLP, saying that I'm writing today to enlist your help in assisting the US House Financial Services Committee, the US House Oversight and Accountability Committee, and my office in gathering data that will be helpful in oversight analysis, protecting shareholder interests, and potential legislative efforts to reform Regulation SHO. And he said upon initial examination, it seems there is circumstantial evidence of a real issue beyond your control with the settlement of those shares of MMTLP into NextBridge Hydrocarbons. And he says, we believe this data that you hold will give us insight into any potential violations of securities laws by outside actors and may potentially uncover those responsible for such violations. This was also directly signed by Pete Sessions, that same member of Congress. Now, obviously, by now we know the SEC and FINRA are paid off by these shorts and by these bad actors, but whether Congress is also paid off by these same people is so far yet to be seen. I guess we have to see how this plays out over the next few weeks and what kind of impact Congress and the House Committee for Financial Services actually has. You may have seen this article that says Robinhood has been hit with a $10 million fine over their platform outages, aka their outright market manipulation and fraud. It says the North American Securities Administration Association said Thursday that Robinhood Financial will pay up to $10.2 million in penalties for operational and technical failures that harmed Main Street investors. And the settlement stems from an investigation spearheaded by state securities regulators in Alabama, Colorado, California, Delaware, New Jersey, South Dakota, and Texas regarding Robinhood's operational failures with respect to the retail market. While it is good that Robinhood is finally being punished, I hardly think a $10 million fine is suitable for the hundreds of millions and billions of dollars that were lost by retail investors due to this market manipulation. The hundreds of millions of dollars, if not billions, if not even trillions of dollars that was stolen from retail investors is somehow being fixed by a tiny $10 million fine. Which, by the way, retail investors won't ever see a penny of this $10 million fine because it will go directly to the SEC or whichever regulator has issued that fine. As Peter said, there's not a penny in restitution to the investors that were harmed by their actions. Now, you may have also seen the courts denied the motion that had already been agreed by AMC and Allegheny in terms of settling the lawsuit. This wasn't something that was proposed by AMC and denied by Allegheny. It was actually proposed and agreed by Allegheny and AMC together, but had simply been denied by the courts. As Retail Stocks tweeted, he said his first hope is that maybe there's a move back to dismissing the case altogether. He said, let's see. Obviously, there's no need for both parties to accept a settlement if the case is going to be dismissed and thrown out altogether. The second motion to deny the case with prejudice, aka to throw out the court case, is actually still in play. It's weird that the courts have specifically denied the motion to effectively settle the case, so I guess we'll just have to see how it plays out over the next few weeks, whether the case is thrown out altogether and dismissed, or whether it ends up going further. But something I did find very interesting is the specific people in this community that want the case to go further and want the reverse split and conversion to be overturned. I found it very coincidental because these same people that want the reverse split and conversion to be overturned are the exact same people that were telling you to sell your AMC shares and to buy APE shares instead. So they started by telling you to sell your AMC shares, and now they're telling you the reverse split and conversion should be overturned. It seems very clear that these specific people in the community have some kind of motivation to try and convince you at all costs to sell your AMC shares. And finally, you may have seen this tweet from Donahue George that I wanted to go through and explain because it really confused me. He said if a shorter has shorted 1 million AMC shares at $50 per share, he's made $50 million. With the 10-for-1 reverse split, he only has to return and buy back 100,000 shares at a post-reverse split price of $30 per share. That means he shorted $50 million worth of shares and only has to buy back $3 million worth. Therefore, he profits $47 million. And he asks and says, tell me how that's beneficial to retail investors. Donahue George is obviously upset that with the reverse split we lose 90% of our shares, and therefore it somehow makes it 9 times easier for the shorts to close out of their positions. But as Berserk tweeted, he said it's the same exact thing if they covered 1 million shares of AMC at $3 per share, which is the pre-reverse split price if the post-reverse split price is $30. So he's basically saying, what's the difference between covering 100,000 shares at $30 per share and covering 1 million AMC shares without the reverse split at $3 per share or $2 per share or $1 per share or however low they push us? And Donahue George said, well, if they want to lock in their profits, then let them close out of their shorts. But obviously they can't close out of their shorts because they've shorted billions of synthetic shares into the market and they have no way out. He somehow thinks that because of the reverse split, where 90% of the shares and 90% of the synthetic shorts are disappearing, it somehow makes it really easy for the shorts to cover and to close out of their positions. He's basically saying that after the reverse split, they can somehow close out of all of their short positions without pushing the price up at all and without causing the squeeze. But I wanted to explain why this is wrong and why it makes no difference to the synthetic shorts being closed out of with the reverse split or without the reverse split, aka why it doesn't make it easier for the shorts to close out of their positions and why they'll still be stuck. So without the reverse split, or if the reverse split is denied, there's obviously still going to be around 3 billion shorted shares. Obviously, there's only a float of 519 million shares, but we know the float is shorted multiple times over. Obviously, because there's way more shorts than there is available shares in the float, it's kind of impossible for these shorts to close out of their positions without pushing the price up. They'd have to buy back every single one of these shorted shares, pushing the price up massively and causing the squeeze. Obviously right now the price of AMC is around $4 per share, but if they covered 3 billion short positions, that would push the price up massively by say 100,000%, and the price would be around $4,000 per share. But you have to remember that after the reverse split, there's still going to be tons of synthetic shorts, especially because you have to merge the synthetic shorts from APE into AMC as well. So after that 10-for-1 reverse split, you're not going to have 3 billion synthetic shorts or 3 billion total shorts. You're going to have around 300 million. But when you also factor in the 3 billion APE synthetic shorts as well, you've therefore got around 600 million total shorts. You've obviously got around 3 billion AMC shorts and 3 billion APE shorts that combine to make about 6 billion shorts, but then after the reverse split, that obviously becomes 600 million shorts. But you have to remember the float is also decreasing significantly as well, and the float is only going to be around 150 million-ish shares after the reverse split. So there's still going to be way more synthetic shorts, well in excess of the float, at least 4 times the float in synthetic shorts. You're also going to have a post-reverse split price of say $30 to $60 per share. And obviously if these shorts tried to cover 600 million shorts or 600 million synthetic shorts, which is well above the float of only 150 million shares, that will still push the price up by the same 100,000%. This time you're not pushing the price from $4 to $4,000 per share, which is a 100,000% gain. You're pushing the price from $30 per share or $60 per share, somewhere in there, to $30,000 per share to $60,000 per share, which is that exact same 100,000% gain. So there is zero difference between the price going from $4 to $4,000 or from $30 to $30,000 because it's still the exact same percentage gain. And either with the reverse split or without the reverse split, the short still cannot cover, as there's still going to be way more synthetic shares than there is total shares in the float. Even after that 10-for-1 reverse split on those synthetic shorts, there's still at least 4 times the float shorted in synthetics because you have to combine the AMC and APE synthetics together and then perform the reverse split. I hope that makes sense as to why it literally makes zero difference in terms of how easy it is for the shorts to close out their positions with or without the reverse split. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.